Hi, my name's Sally Henry. I'm Vice President of Business Development for Key Data, and I'm delighted to bring you a UK market update here today. Now, not an opinion. Without data, you're just another person with an opinion. It could be an amazing opinion, but we'd like to bring you some market data to help you make better decisions for your business. So we're going to take a look at some historical performance. How has the market been feeling? What was happened last year? What are those lessons we can learn? We're going to look at the big five: occupancy rates, revenue, length of stay and booking windows. And then we're going to take a look at some traveller behaviours as well. And we're also going to have a quick dive into Easter as we approach those big Easter holidays and finish up with some takeaways. So first of all, the data that we share with you today is taken from our directly integrated property managers. So at Key Data, we integrate directly with property management systems and large property managers to get the most accurate view of data that we can. We take everyone's data, we aggregate and anomalize it for market benchmarking. We do scrape Airbnb and Vrbo on a daily basis too, and we train the two data sets together to get that laser sharp view of the market. Today, all the data I'm going to share is from our directly integrated property managers in the UK. So to take a quick dive back to 2019 to last year, and what I want to do first of all is explain the occupancy metric that we're going to be looking at. So at Key Data, we understand if a booking is from a paid guest, whether it's an owner stay or whether it's a maintenance hold. So what we're looking at first of all, this occupancy metric is guest paid occupancy. So this is where a guest is actually paid to stay in the properties. What we can see here, we can see back to 2019, pre-COVID. We can see this 29% figure. We can actually see now in 2024 last year, we enjoyed 39% guest paid occupancy. One word I'm going to use that we've seen quite a lot in this occupancy figure is pretty flat. 39% last year is 40% the year before. If we take a look at ADR, again, we've seen these marginal gains come up over the last few years after that post-COVID boom. And that means our RevPAR, so effectively that combination of our occupancy and our rates, that's looking pretty flat as well, exactly the same for the UK, 2023 to 2024. So you're going to hear me say the word flat quite a lot in terms of how the market is looking over the last couple of years. And just so we do talk a lot of people like to refer back to 2019, those pre-COVID years. We're considering 2023 and 2024 as normalised years now, where we're seeing some standard trading coming through. Okay, we just take a quick look at what we've seen in the length of stay and the booking window. So again, we've seen the average length of stay contracting. We are seeing that happen around the world as we respond to some of these macroeconomic conditions that we are experiencing. We are seeing people are still travelling, but maybe staying a little less time. And also, obviously, everything is back on the agenda now. So hotels are back, cruise is back open. So the long haul, short haul, all inclusive, it's all there for guests to have as a consumer choice. So we are seeing that length of stay contract, and that booking window has been pretty steady the last couple of years. We are seeing people book earlier, we're seeing people book very late as well, so hence seeing almost a V-shape in some of those average booking windows coming through. Obviously, these metrics change enormously depending on the type of properties you have and where you're based, but these are giving you a good feel for the average of, how has the market been looking over the last few years, and certainly the last couple of years we are looking pretty flat. Was there anything to pick out last year, split by country at a country level? So again, you can see that the guest paid occupancy in the UK was a little softer, like -3. Northern Ireland suffered stronger, like that, from just 25% guest occupancy, and that's contracting down 7% as well. Whereas in Scotland, we enjoyed like +3% in guest paid occupancy growth. If we think about some of the regulatory issues that have been faced in Scotland, we have seen supply slow down, the growth of supply slow down rather than compared to the other countries. So we're enjoying some slightly stronger occupancy growth there. And Wales, again, sort of it's sat around 37, just under that UK average in terms of guest paid occupancy. And again, contracting -5% year on year. If we took a look at the flip side, at the rates, remember we always have to look at occupancy and rates hand in hand, and we're seeing the UK at +3, so as we're seeing that -3% in guest occupancy, we're seeing +3% in rates. Northern Ireland rates pretty flat. Scotland managing to push up rates even further. They have that positive occupancy, they've got stronger positive rates, and Wales also seen as +3% in rates. Looking at that, Scotland are commanding the highest ADR, whereas England coming in second, Wales third, and Northern Ireland with just an average daily rate of £99. What does that mean for RevPAR? So that's when we combine again those two metrics of our occupancy and our rates. So we can see England flat, that sort of softer occupancy balancing out those rate gains. Northern Ireland sort of doubles down, just that flat rates couldn't obviously compensate for that lower and softer guest occupancy, but Scotland pushing up their RevPAR the most with both positive occupancy and positive rates. And Wales, even though we had that rate growth, it's not managing to push up the RevPAR because of that softer occupancy. Length of stay, all but Northern Ireland, we're seeing that contracting of length of stay again, -3 in England, Scotland a little less, Wales seeing this -5, so that contracting of length of stay is something that we saw year over year from 23 to 24. And then looking at the average booking window again, very little to report on here, just a 1% swing either side. So this is where you need to really dial in and understand what is coming through for your types of properties, what pace are you expecting these bookings to come in for your booking windows. Talking of pace, let's take a look at how we are pacing year on year. So effectively here, I'm going to talk you through this graph. So we have the 2023 and 2024. So we can see that guest paid occupancy again, 23 in the gold, 40% down to 39% in 2024. And then what we did, we took a look at confirmed bookings on the books on March 22nd this year compared to March 22nd last year to see how we are comparing like for like. And we can see we are very slightly softer down in 2025 compared to where we were this time last year in 2024. So graphically speaking, you can see this dark blue line is 2025, the red line is 2024 where we were pacing, and this shaded area that looks like a mountain, well, that is where we finished up last year at the end of 2024. So a couple of things to note. Jan and Feb when the data is run is done, marginally up Jan and Feb, just a smidgen up. And then we've got March and April, which is effectively flipping around because of Easter. Easter was in March last year, and it's 3 weeks later in April this year. So we're sort of seeing this reverse happen there. But really, as a key takeaway, what you're looking at is that dark blue line is a little under the red line, right the way through to the end of summer. So we are pacing slightly down at the moment for this summer compared to last summer. You can see where we're going to end up, or end up at the end of 2024, just to see how much we still have to go. But again, keeping an eye on that peak summer, again, pacing down just a little. We see where we go then by region. Is there anything we can be pulling out by region? What we see here, if it's green, it is seeing positive growth year on year. And if it is red, we are pacing behind where we were this time last year. So we are seeing widespread decreases, just as we saw, we are pacing a little down, looking especially in Northumberland and Cornwall in particular, also the Yorkshire Dales, the Peak District, pacing down. We can see the Highlands, we are looking at positive in addition to the Cotswolds, London and Northern Ireland. So again, really important to dial into the different regions and micro regions within your portfolio. Edinburgh here is seeing really experiencing this dramatic decline in guest paid occupancy year on year. We flip to the next metric now, the ADR, the average daily rate. And as we could see before, we're seeing these marginal gains in the daily rate pushing up. So from 23 to 24, we sort of pushed it up an average of £5 per night. And we're pacing just a couple of pounds up versus where we were this time last year. So again, if we look graphically, we can see this dark blue line of 2025. We finished marginally up in January, very marginally, pretty flat in February. We're dipping down in March. when this data was run. Obviously having Easter at a different time, but then we're seeing opportunity in April and May as we're pacing above that red line of 2024. What I will see, that shaded area where you finished up, where we did end up, you can see that difference between the red line where we were pacing this time last year versus where we did finish up. So rates will come down as we go through the seasons. So effectively, is there a way to try and reduce prices or balance those prices so they don't get constrained as much or contracted as we approach those really imminent departures, because we do see rates get squeezed. So we see here that the peak summer rates pretty identical, are following a very similar pattern to where we were following and pacing this time last year. Most people we spoke to last year asked if rates were too high in the summer. You can see them really pushing up. You can see where they did end up. But effectively, I think everyone's decision in terms of the rates versus occupancy is we'll see if we win out when we get to the RevPAR metric. So how are we seeing that compared to different regions, compared to occupancy? We can see many more greens. See greens at many regions, all but the Highlands. Remember, the Highlands are enjoying that positive occupancy, whereas we can see that rates are getting pushed up in most. Snowdonia's got this like 25% rate growth in pacing. It is from a lower than average base, but still commanding higher rates. And we see some other areas, from Fries and Galloway, Pembrokeshire, the Dales, all experiencing double-digit rate growth. It's just those Highlands that we're looking at. I just wanted to try and help you visualise this correlation between occupancy and rates. So you can see here where there can sometimes be a flip. So people taking higher rates and sacrificing occupancy, and vice versa. And you can see Cotswolds and London with positive occupancy, but we've got these flat rates. Again, there's this correlation between the two. So super interesting when you can see it visually strong with millions of rows of data. It can help you understand that correlation. So now we look to RevPAR, so when we're balancing the two out, and again, I think I use the word flat, so 23 to 24, it is flat. We are pacing flat, so for in 2025 compared to 2024. So again, you can see that dark blue line, so Jan, Feb, marginally up. March, that softer occupancy, we're not pushing rates either, so we're seeing that RevPAR drop. But again, opportunity in April when we see where Easter falls. What I will point out is this real strong peak in the summer, that reliance on revenue coming in July and August. It would be fabulous. I'm sure it's what keeps you awake at night, how to flatten out some of those peaks. But we're seeing peak summer just pacing down very slightly, with those rates not quite offsetting that softer occupancy. But we're following a very similar trend to last year. Looking how that balances out at a different region is a pretty mixed performance. We're seeing Northern Ireland, Cotswolds, Dumfries and Galloway pushing some RevPAR growth. Edinburgh seeing that really strong red colour there of those like strong declines in RevPAR. So it's so important to get that balance right. And again, we urge you to use data to help you win at that strategy. Now we take a look at average length of stay. I've already said we are seeing that contract. So from 23 to 24, it's down 0.2 of a day. We are pacing down 0.2 of a day as well. And again, just like with rates, we will see length of stay contract as we go through the season. You can see where we were pacing this time last year and then where we ended up, that shaded area. So obviously, if your durations are shorter, you're going to have to just sell more to get the same percentage occupancy. I advise you to look for gap night strategies. Effectively, guests tend to book for longer, and the further out they book, and they're happier to book those short breaks closer to arrival. So again, those length of stays are going to come down as we navigate through the season. Seeing how this looks across the country, effectively we are seeing it's negative and flat as we've seen across the board. Cornwall, it commands the longest length of stay with just 6 nights, so again well above the UK average. And then you look at Edinburgh. Edinburgh has a shortest at just 3.3 days. But I think it's really important to be able to use this data to communicate with your owners to make sure you have the right length of stays available at the right time, to make sure you're attracting guests and understand what guests are looking for in the market. Then we look at the booking window, and again, it was a little strange this far early on in the season, but you can see 23 to 24 is really flat within a day, that booking window. It's a really similar metric, but we're looking about a week shorter at the moment, so we are pushing that later market this year. So again, it's just about being prepared well in advance with your booking window. Know what to expect, use this data so that you can communicate with your owners, understand if you think you should have had the bookings through as to hold your prices, extend your different channels and distribution to make sure you are capturing the guests at the right time. And again, looking at that, we are seeing this shorter booking window come right the way through. Interesting, the Highlands has the longest booking window. On the flip side, we've got Northern Ireland and London with the shortest booking window. And it's only Snowdonia, our friends in Wales there, who are seeing a longer booking window, very, very small changes really. Interesting to see Devon, we pulled Devon out, minus 26% in booking window. And Northern Ireland minus 31. So really a strong shortening within those markets that you would need to navigate and be able to explain to owners what is going on. Now, what does that mean if we're seeing this shorter booking window? How does that impact your business? Well, this graphic here is basically saying that lighter green is for any bookings that are made to depart within 2 weeks, so that's 14 days. And the average daily rates for any bookings made within that sector for the 2024 arrivals was £114. Now, that accounted for 30% of all reservations for the UK through our clients in 2024, but only 19% of revenue. So again, reservations doesn't necessarily correlate with your revenue. And if we look at the other extreme there, so the ADR, that dark green, the ADR for any bookings made 180 days out, so that's 6 months out or more, is £190 as opposed to the 114 we see for that shorter booking window. Now that accounted for 15% of reservations, but actually 25% of revenue. So if you ever need to see that seesaw of how that shortening booking window, what the effect is on your revenue, it's really stark to see. So bookings made that 6 months out are really commanding those higher rates, but the greatest percentage of reservations and revenue are that 3 months to 6 months. That's really important. But that correlation is something maybe you can make sure you are explaining within your business too. Looking at how we're pacing or how we're doing for the first quarter, so from bookings for arrivals from the 1st of Jan to the 22nd of March, you can see that even more highlighted. So the ADR of in Q1, a little lower, £96 for anything that was arriving between 0 and 14 days. It accounted for 45% of arrivals in the first part of this year and 33% of revenue. And again, looking at the other extreme, any bookings made to arrive 6 months out or more, £187 ADR. It's only 5% of reservations for Q1 arrivals, but accounted for 11% on revenue. So the impact on revenue when we have a late market is something I would urge you to be factoring in to your business and your understanding. We're taking a quick dive into Easter week. So we actually did this a week later. So direct data, reservations made on as of the 30th of March. And effectively, we're looking to see what was happening with Easter. So obviously it's 3 weeks later. So we've got some different lines here. That blue line there is for 2025. So you can see here, obviously we're dipping below 2024. Because our main Easter week is 3 weeks later. Now, what we can see here is 3 weeks before Easter for 2024 Easter. This is a yellow line, and we were at 35% guest paid occupancy, and then we finished up at 46%. So in that time, we managed to shift, if you like, and grew 11 percentage points in paid occupancy. So if we narrate the same and we grow at a similar pace that we are seeing at the moment, we're going to grow probably 10 to 11 percentage points on where we're currently sat at this 38%. So we should probably end up around 3 percentage points above where we did for last Easter. Obviously, the sunshine has been super kind to us this last week as well. So that later Easter and the good weather is hopefully pushing for some late Easter surge and allow some occupancies to be pushed from last year. So good opportunity in Easter. We had a quick look to see, are we seeing any shifts as we see these macroeconomic conditions bite a little? People are feeling a little bit more discerning in how they spend their money. And we can see this growth in studios and 1-bedrooms at the expense of 3-bedrooms. So again, thinking of where you're positioned in the market, do you have a portfolio of smaller properties or large bedroom properties? We are definitely seeing a shift, a very slight shift in reservations to those smaller properties. If you see that, it's moved from 22% of all bookings to 23% last year, and this year we're looking at 24%. So again, seeing that small, just be mindful of the macroeconomic environment and how people's behaviour may alter. We took a quick dive into who is booking to travel. Let's look at these feeder markets. And again, just a few things to highlight. So the English like to holiday domestically. They like to go to England and they spend as much as they do. The percentage of reservations equals the percentage of revenue. The Scottish like to stay in Scotland, but they don't spend quite as much. The English spend more when they go to Scotland than the Scots. And the Scottish certainly don't seem to be travelling to Wales. The English spend more when travelling to Wales than the Welsh. And this time last year, we were looking at sort of 2023 as a whole. We saw the US in the top 3 feeder markets, and that is not currently there. So understanding your feeder markets, I'd clearly go a lot more granular than country to country, understanding some drive times and who is travelling and when do you expect them to book. Again, really important metric to dive into. And speaking of feeder markets, if you're wanting to attract some variety of international or inbound guests, I urge you again to think about using the channels. And not all channels are equal. And you can see here we see Airbnb and Booking as a vastly dominant OTA channels for the UK, but you can see they do bring in a different type of guest. So the average daily rates from Airbnb and Booking here is about the same, 122, 120. You look at Vrbo, it's 159. So there's quite a significant difference. We do know that some of our property managers may inflate their prices on the OTAs versus direct. But we see really looking at this type of traveller behaviour. So the average length of stay is shorter on Airbnb and Booking compared to direct and Vrbo. And equally that booking window is much shorter for Airbnb and Booking. So great to tap into that late market. But if you use these channels extensively, they will be dictating a certain type of behaviour in your company. So understand your portfolio. These channels are going to work differently for different types of properties and different geographies, but make sure you're optimizing your channels. So we are seeing continued trends that we saw last year. We're seeing a softer occupancy. We're pushing rates up to compensate, which means we're ending up with a pretty flat RevPAR. Those length of stays are getting shorter, and our booking windows are seeing some really late bookings coming in. And as ever, you are stuck in the middle. Guests want more value. Owners want stronger returns as some of their operational costs are pushed up. But, summer 24, it was riddled with distractions. We had the general election, we had the Euros, we had the Olympics, and we had terrible weather. So there was a lot of things we're trying to navigate. As ever, there will be macroeconomic factors we have to deal with and respond to. Again, I urge you to use data to respond to some of these. We can certainly help you navigate and control what you can control. And also use data to communicate within your business and to communicate with your owners. Thank you so much for listening to the update.